Bitcoin introduces another thing you can do, which is hold a scarce asset on your balance sheet. So you're protecting yourself from debasement, but you're also not, turning your whole balance sheet into liabilities and basically decapitalizing yourself as much as possible. When capital is not, kind of respected, all these companies said, well, we don't want capital then. And so this is a new tool to actually have capital. The fiat system is hundreds of trillions of dollars globally, and Bitcoin's a $2 trillion asset. And then, these leveraged Bitcoin entities are still in the hundreds of billions, most of it being MicroStrategy. But even the long tail of a lot of others is still not that big. So I think that over time, the market can absorb more of it.
In this insightful breakdown, macro investor and crypto visionary Lyn Alden explores the revolutionary implications of Bitcoin on corporate finance and the global economic landscape. With fiat currencies continuously debased and traditional corporate strategies increasingly reliant on debt, Bitcoin presents a radically new alternative, a scarce, appreciating asset that can sit on a company's balance sheet as real capital. Explains how Bitcoin isn't just a speculative investment, but a structural shift in how capital can be preserved, leveraged, and strategically deployed. As more firms adopt Bitcoin treasury strategies, the financial system itself is evolving in real time. This isn't just about MicroStrategy or a single bull run. It's about the emergence of Bitcoin as both an economic hedge and a tool of financial engineering. Whether you're a crypto veteran or new to the space, this narration dives into why Bitcoin may redefine capital structure, long-term value, and balance sheet resilience across industries.
Bitcoin's off to the races, hit a new all-time high, 109,000. The thing that I have been completely absorbed by, and I'm guessing you have as well, is the new Bitcoin treasury strategy companies that are popping up. And it seems like we sort of have like this new financial asset, creating these new financial products and maybe creating a new financial system in front of us. And there's all these new metrics like Bitcoin per share and MNAV and things like that. I'm curious your take on this Bitcoin treasury strategy play. Is this building a new financial system with a new financial asset, or is it sort of running the old playbook on a new asset?
I think there are two things happening simultaneously. I think one, it just makes sense for balance sheets to have the best money. And so I think that's a more structural shift. That basically, if you're a business, instead of holding melting ice cubes, fiat currency, or instead of decapitalizing yourself, basically giving all your money back to shareholders as share buybacks or dividends, and perps taking on debt you don't need. Like Coca-Cola has like 40 or 50 billion in debt, despite being profitable every year for like a century. And the reason they do that is because why would you not issue 30-year bonds at 2% if you can? It's basically financial arbitrage.
Right.
And so that's been the name of the game. These big successful blue chip companies, they take out debt they don't need because they can and it's cheap, and they basically short into currency for 30 years at 2%, which is great.
Yeah.
They're buying back shares, they're paying dividends. So Bitcoin introduces another thing you can do, which is hold a scarce asset on your balance sheet. So you're protecting yourself from debasement, but you're also not, turning your whole balance sheet into liabilities and basically decapitalizing yourself as much as possible. When capital is not, kind of respected, all these companies said, well, we don't want capital then. And so this is a new tool to actually have capital. The other strategy, I think, on top of that is arbitrage, which is if this currency is going to keep weakening, we're then going to try to issue debt in that currency and buy this way better currency. You see this to some extent whenever you have like an emerging market currency crisis. There are companies there that say, well, we could take out bank loans in our failing domestic currency and buy dollars with it. That seems like a good trade. And then sometimes you'll say, for example, like this is happening in Turkey, where they would then come in and say, well, if you're a business that holds dollars, you can't take out a loan in the local currency because we don't want you, basically doing a speculative attack on our currency to buy dollars. That's kind of what's happening with these leveraged Bitcoin entities. They're kind of doing speculative attack on the dollar, buying Bitcoin. But of course, the dollar can absorb a lot bigger attack than a developing market currency. And so there are, I think, arbitrages that are happening, and rightly so, because when the opportunity is there, there are entities that are going to take it, and those that do it earlier get disproportionate gains. And then the question is, what percentage of them or which ones will nail the turn? Like when this eventually gets overdone, excessive, and dangerous, which ones will have the best risk mitigation in play to get through a bear market without having to liquidate at an inopportune time, and otherwise just knock it over their skis.
Right. So it's almost like like you said, it gives these public companies a new option as opposed to just leveraging up with debt. So it's almost like maybe buying Bitcoin is like the new buy back your shares sort of strategy.
Yeah, it's a new tool in the toolbox, and it's not necessarily saying that it's always the better choice, but it's certainly a new variable. All the other choices basically involve decapitalization, and this is the first one where you can retain value without decapitalization.
Yeah.
And I think that up to a point that makes a ton of sense.
When I look at like a company like MicroStrategy, at the Bitcoin Opportunity Fund, we're looking at a lot of these deals. I'm sure you guys are over at Ego Death as well. And we're looking at these deals, and it's always like, well, how do we value this thing? And it's like we have these new strategies, these new companies that are building, and a lot of it defaults to this old narrative is like, what's the underlying business model? But when I look at like MicroStrategy, it's like, well, they used to be software, but now they're sort of just like financial products. So MSTR, STRK, STRF, they're sort of like financial products that they're bringing to market, almost like maybe like an ETF. And then I think of it like, well, I mean, I guess the market could bear thousands of financial products. So maybe it's not as bubble-esque as some people think it is right now, or do you think it's sort of hitting that level?
I don't think it's too bubblicious yet. I think it goes through periods of micro bubbles. I tend to, when MicroStrategy is hitting like over 3 times NAV and every single person on Twitter is talking about it, that's when it tends to get temporarily overdone. And then it goes through a period of consolidation. The market digests that move and then potentially sets up a new round higher in the coming months. There is somewhat of a network effect here. So liquidity really matters. And having a liquid option market really matters. So MicroStrategy is kind of in a unique position where their equity is very liquid, their options market is very liquid, and so that is a pretty self-sustaining network. It's hard for like another entity to become MicroStrategy and have 100 different MicroStrategies on the market. But I do think that the overall market size can absorb quite a bit of this. I mean, the fiat system is hundreds of trillions of dollars globally, and Bitcoin's a $2 trillion asset. And then these leveraged Bitcoin entities are still in the hundreds of billions, most of it being MicroStrategy, but even the long tail of a lot of others is still not that big. So I think that over time the market can absorb more of it. And even MicroStrategy, there was a pause during the bear market. They weren't really, it was the cycle was temporarily over. But then it came back once Bitcoin entered another bull market. So it can absolutely get overdone for periods of time. It's like, how much can the market absorb at once? Right. But then when the dust settles and anyone who did it improperly maybe gets washed out, a new base builds, and then potentially there's another round of arbitrage. And this can get pretty big because the mismatch in size between the Bitcoin ecosystem and the fiat ecosystem is huge.
Yeah, that's what I was thinking. It's like, as long as they can continue to arb that, right? As long as the rate to borrow is well below the rate of appreciation, which seems like it's going to be that way for a very long time. But I guess then you have to decide how much liquidity will there be available for the debt. But I think, to your point, if you have a long enough time frame and you believe in Bitcoin, then it seems directionally correct. But yeah, who knows who's going to get caught upside down when the tide goes out, as Warren Buffett would say.
Exactly.
Yeah. All right. Well,
and that was the Berkshire playbook on a lesser scale. I mean, part of why they're so successful is that basically what Buffett and Munger did was they bought a bunch of blue chip equities, basically with debt. And they managed it so they never blew up. So the reason they basically bought insurance companies and operate such a big insurance company is that's a really cheap source of leverage. That entire insurance float is basically their liabilities. And so they're, in addition to issuing debt, which Berkshire would do, they would also their insurance float is a type of leverage. And so they basically own a bunch of blue chip stuff at moderate leverage, make sure they don't blow up during recessions, and therefore compound at a good rate. And so if the best leveraged Bitcoin entities do essentially the same thing with Bitcoin, they can have similar long-term success, and just the key is never getting over your skis.
Lyn Alden breaks down the rise of companies like MicroStrategy using Bitcoin, not just as treasury reserve, but as a strategic capital asset. Unlike traditional balance sheet tools like debt issuance or share buybacks, Bitcoin offers a way to protect corporate value without increasing liabilities. He likens this to an arbitrage strategy where companies can borrow cheap fiat and buy appreciating Bitcoin, much like emerging markets borrowing in local currencies to accumulate dollars. This isn't just speculation, it's corporate hedging at a macro scale. Compares it to Warren Buffett's playbook of leveraging insurance float to buy quality assets. It's all about controlled exposure and survivability during downturns. As Bitcoin's market grows, so does the infrastructure around it, like liquidity, options markets, and new valuation metrics like BTC per share and NAV-based pricing. This is more than a bubble or trend. It's a potentially enduring system that merges capital markets with digital scarcity and decentralized monetary logic.
Emerging market recessions and developed market recessions look different. So, for example, in an emerging market, you often won't get an unemployment spike. I mean, it depends on the type of recession they're having, but often what happens instead is it's basically a currency crisis. It's kind of like this inflation wave, and so everybody kind of feels poorer. And yet there's not really this big like labor cycle change. It's more just like imports more expensive. They're getting less per hour worked. There's an economic malaise that is happening, but the units are being treated differently. If you look at a lot of numbers, in many ways, 2022 was a recession in the U.S. For example, if you look at the misery index, which is unemployment plus inflation, that was basically a recession level misery index. But it was more from the inflation side than the labor side. When you look at, for example, bank lending, so how many, what percentage of banks are tightening credit availability versus loosening credit availability? That 2022 year was like the only time in modern history where we hit something like 40% of banks tightening at once, and without a recession on the record. And again, because that was kind of I would say that was basically a recession. Like most people were worse off that year than 6 months or 12 months prior. But it didn't show up in a big labor cycle change. It instead showed up in this kind of inflation wave where everybody's kind of a little worse off than they were at the sugar high of the stimulus, because that delayed inflation hit and their wages weren't going up at the same rate. And so everybody's kind of taking this kind of shared pain. So in a typical developed market disinflationary recession, most people don't lose their jobs, but those that do are greatly impacted. Whereas in a more inflationary emerging market style recession, fewer people lose their jobs, but the pain is kind of spread through inflation. And so it's a different type of pain. And I do think that basically recessions going forward in the developed world are more likely to have some of those characteristics, where some of the pain is felt more in monetary debasement, rather than these kind of typical cycles we've been through. And part of that is because bank lending is less important, or less like a lower magnitude relative to fiscal deficits than it used to be. For most of the past, call it 50 years, in any given period of time, net bank lending is a bigger dollar amount in a given year than fiscal deficits. With generally the only exceptions were like maybe you'll see a 12-month period during recession where briefly fiscal deficits are bigger and lending has contracted. But now in this kind of period of fiscal dominance, even when we're not in a recession, fiscal deficits are usually bigger than bank lending. And so this is kind of this more background running hot. And so it's actually pretty hard to have the type of recession we've come to expect. But that doesn't mean you can't have periods of economic weakness or people kind of correctly feeling that they're worse off than they were the year before.
It concludes with a broader macro view, suggesting the traditional definitions of recession and capital risk are evolving. With developed markets shifting toward fiscal dominance and inflationary slowdowns, many people feel worse off without the usual employment collapse.